Lesson 4, Trading Indicators. Before we get started, I'd like to ask you to read what you see here in front of you. I would also like to point out that as we go through this lesson, in the center of your page, you'll see a number at the center bottom. That is the number of slide we are working on. If by chance in your workbook you get lost or behind or lose your place, just look at the slide number at the bottom center of your page and then find it in your book, and you'll be up with the lesson. Another thing I'd like to point out is I have created a sign that says important information. That sign is for a perhaps trader's tip or very critical and or important information that can help you learn to trade. These are things that you may want to memorize and make it a part of your trading style and technique. There are 16 lessons that teach people how to trade that can help you trade not only on the Forex but focus in on technical analysis. Technical analysis is the study of chart reading. When you learn technical analysis, it is applicable to all charts, whether you're trading stocks, commodities, currencies, whatever it may be. That education can be quite helpful. Several years ago, I heard this statement: successful traders will do what unsuccessful traders can't and won't do. This is probably one of the most profound statements I've ever heard. Change the name traders and turn it into people. Successful people will do what unsuccessful people can't and won't do. Successful people are successful for a reason. They have become successful because they have bought into an education on whatever it is they are doing, and have also bought into being disciplined in a niche business. Success comes from being disciplined. Successful traders are disciplined individuals. Successful traders have taken the time to educate themselves about the market. They understand how the market works. They understand how they need to work as an individual trading in the market, and therefore they have acquired a set of disciplines that allow them to become successful in the market. Successful traders will do what unsuccessful traders can't and won't do. Several years ago, I became apprised of this 21-day 3% rule. The human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it will continue the loss of information until it settles at retaining only 3% of the original acquired information. That means that after you listen to this lesson, within 3 days, you will have forgot 80% of the information that has been given to you from this lesson. Taking that into consideration, I admonish you to listen to this lesson over and over again until you extract the important information that can help you become a better trader. When it comes time to open up your margin account and start trading, our focus as a company is to help you place yourself in a position to have 80 to 90% recall of the information you have been taught, and place you on the side of hopefully becoming successful as you trade. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. You will be introduced to the technical side of dealing with an indicator. You will learn to use these indicators with your other knowledge. You will learn to find a trade with an indicator and only trade it with equity management. You will learn to create a trading plan, trade that plan, and financially protect yourself in every trade. Before we get started, let's review reading a trading chart and placing orders. We focus in on using Japanese candlesticks. You can use bar charts. You also can use line charts. Japanese candlesticks are very user-friendly. They monitor an open, a high, a low, and a close of a time period. Japanese candlesticks can be 1-minute candlesticks, 5 minutes, 1 hour, 2 hours, 4 hours, daily, weekly. There are bullish candles and there are bearish candles. In a bullish candle, the close is higher than the open, and are usually hollow in color, to where a bearish candle, which signifies the market is going down, its close is lower than its open. All the charts we look at are bid charts, and charts are monitoring a bid and an ask price. As the market is moving, you can either choose a bid chart or an ask chart, but the majority of traders use bid charts. All charts are bid charts and display the bid price and the bid movement. There is that spread between bid and ask. An ask chart, depending on the spread, would look identical to the bid chart, other than it would be anywhere from 3 to 10 pips higher than the bid price. As the market moves, the market is monitoring price movement, with the bid being recorded in front of you and the ask price being recorded approximately 3 to 10 pips higher. As you place orders on the Forex or in the market, just remember, we buy on the ask and we sell on the bid, which means when it's time for you to place an order, if you are buying, you will enter the market buying on the ask, and you will place your protective stop loss orders at the last low if you are buying, and that protective stop loss order, in this case, since you're buying, you would have a sell stop, which is on the bid. You would also have a sell limit, which is on the bid for profit. If you are selling, entering the market, shorting the market, your protective loss stop would be on the ask because it would be a buy stop, and your protective or your limit, buy limit, will be on the ask for profit. Keep that in mind as you trade. Remember that as the market moves and as prices are being recorded, the market is monitoring the bid price, which means the ask price is just a few pips higher, 3 to 10 pips higher, which means if the market comes close to your buy stop order, the ask will hit it before the bid, which means if you have a price at which you have placed a stop order at and the bid price does not hit it, chances are the ask price might have hit it, but it's just not recorded because this is a bid price chart. Types of orders. We have taught you in lesson 1 the market order, the limit order, and the stop order. Remember, market orders are at the market, limit orders are at a specified price, and you will be filled at that order or better, and a stop order is at a specified price that turns into a market order when hit. Keep in mind, if that is where the market is, any order that is placed above the market would be an unfilled working order, an open order, and that order, if you are buying above the market, would be called a stop order. If you are selling above the market, it's called a limit order. If you were to place an order anywhere below wherever the market is, that order would be an open order, a working order, an unfilled order, but it would also be called, if you are buying below the market, it's called a limit order. If you are selling below the market, it's called a stop order. Those are the rules of trading. It's something you will have to memorize. Don't worry about it. It becomes very easy to understand as you start to practice and trade. Ordering rules, every time you enter, you should have 2 exits. When you buy and your position is bullish and long, you should have 2 sells, one for profit and one for loss. Do not trade without a quantified stop order. Conversely, or if we look at this chart, let's just say the market breaks this trend line, it enters into the buy zone, which is lesson 6. You end up buying, you need to place an order at your last low, and this limit order for profit will be a sell limit order, just like this will be a sell stop order. Ordering exit or ordering rules, every entry should have 2 exits. Every time you sell as a bear, having a position that is short, you should have two buy orders. Every sell has two buys, one for loss and one for profit. Let's look at this chart. If you short the market here, you should have a stop order for loss and a limit order for profit. An OCO, which is whenever you enter the market, you should have a sell order for profit, a sell order for loss. On a buy, it would be the opposite on a sell. But an OCO means if we enter here on a buy, if the market rallies and hits the limit order, it'll automatically cancel the stop order. If it hits the stop order first, it'll automatically cancel the limit order for profit. Therefore, you don't have to sit around and watch the charts. You can just set it and forget it. Cancel, replace. Please go to Lesson 16, which focuses in on canceling and replacing, as well as Lesson 3, Equity Management. But to properly cancel and replace, remember, do not cancel and replace if you are chasing the market until the market has established a new high. Cancel and replacing is a very profitable way to chase the market and lock in profit along the way. As you cancel and replace shorting the market, only cancel and replace to the last high after the market has made a new low. If we were to sell the market here with a stop order there as the market makes a new low, we then can cancel or replace our stop from the last high to the new high. As it makes a new low, we can move it from that high to this high. As it establishes a new low, bounces, retraces, and then U-turns and makes a new low, we can now go from that high to this high, from this high to this high, from this high to this high, from this high to this high, locking in profit as we go. Very effective way. Remember, bulls buy low first and then sell high later. That's what a bull does. They enter the market buying first and selling second. The objective in making a profit is to buy low and sell high. Buy low, sell high. Buy low, sell high. Indicators can play a big part in that success. Remember, if you're shorting the market, you will sell high first and buy low, which is the opposite of buying low and selling high. Learning to short the market is taught in Lesson 1. If you have any questions about it, feel free to call our company or read the end of this lesson in your work manual. It'll explain to you in detail what shorting the market is about. Be that as it may, bears want the market to fall. They want the market to dip, go down, have a reaction. As the market dips or falls, traders that short the market sell first and buy second. They can use indicators that can help them sell high and buy low, which is buying low and selling high. Technical traders learn to read charts. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives a trader a high probability of knowing where the market is going. That's what these lessons are all about. A chart is a chart is a chart. Technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read charts, you will start to control your financial future. Whether you own stocks or whether you trade commodities, any of the securities or equities, whatever it is you trade, your mutual funds, once you've been educated on how to read a chart, you are no longer vulnerable to hot tips or to advice of brokers who are just trying to get you to make a trade. This lesson, as we move forward, I want to do a quick review on support and resistance, which is level lesson 2. We are once again looking at Japanese candlestick charts. A high is established by having two candles to the left that are lower than either the wick or the body high, two candles to the left and two candles to the right that are lower than the wick or body high. Remember, not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently trading. That is all discussed in lesson 2. Lows are the opposite of a high, to where you have either a body of the candle or the wick, which is lower than two candles to the left and two candles to the right. Not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Please refer to Lesson 2 on support and resistance to clearly understand that. But before you trade, please mark and find all your levels of resistance and all your levels of support. Finding your levels of resistance is like stepping up a ladder. Remember, every single level of resistance needs to be higher than the previous level, just as every level of support needs to be lower than the previous level of support. It would be like walking down a ladder. Do not underestimate the game between the bulls and the bears, as far as the bulls trying to achieve higher highs or the bears trying to achieve lower lows. Bulls are trying to establish new highs and take out old levels of resistance. Bears are trying to establish new lows and take out old levels of support. To also help you in this lesson, I'm going to do a quick review on trends and trend lines, which is Lesson 5. The market moves in waves. Those waves are called price swings. We discussed price swings in detail in Lesson 7, which is price swings and Fibonacci numbers. But in an upswing, you start at a low and stop at a high in monitoring an upswing. Let's look at this chart. Look at this upswing. It starts at a low and ends at a high. That is an upswing. Whenever you have a low and a high established, that becomes the upswing, and then it slowly starts to retrace. An uptrend is the market making higher highs and higher lows. As the market is making higher highs and higher lows, that is called an uptrend. When you spot an uptrend, you will draw your trend line across the lows, just as you see in this chart. Remember, your trend is your friend until it bends. As long as it is staying on the north side of the uptrend line, the market is still staying very bullish. The market has a tendency to bounce at the trend lines, as discussed in Lesson 5 on trends and trend lines. There are three primary upward trend lines that we're monitoring. One is the inner, the outer, and the long term. Downtrends work exact opposite. You start at a high, however, in a downswing and stop at a low. Look at this chart. We start at a high and stop at a low. That is called a downswing. The market moves in swings, as you can see. It's swing 1, swing 2, swing 3. It's always making swings. A downtrend is lower highs and lower lows. Look at this, how the market moves. It creates a low and then it creates a high. Then it creates a new lower low, then a new lower high. This high is lower than the previous high. This low is lower than the previous low. This high is lower than the previous highs. It's making lower lows and lower highs. That is a downtrend. When you draw your downtrend line, it goes across all the highs. Look at how we are drawing the downtrend line across the highs here. Once again, there are inner, outer, and long-term trend lines that we monitor. Whenever the market breaks one trend line, it starts to go to the other trend line. Now let's get started with Lesson 4, which is trading indicators. Many traders like trading indicators. Every trader is trying to find the Holy Grail in trading. We just all want a quick fix. We just want an indicator that can make us all kinds of money. Well, I'm here to inform you that there is no Holy Grail. Traders are searching for a way to make money, and we have a tendency to gravitate towards indicators as a way to make money. Traders are trying to find comfort in the number they trade. They want to be right. Every trader is doing nothing more than trading numbers, if you think about it. Let's say we're trading Microsoft stock. You have to pick a number. What? $55 a share, 55 and a quarter, 55 and a half? That's a number. If we're trading currency, we're trading an exchange rate. We're getting in at 103 Japanese yen traded against the US dollar. That is a number. Either way, we have to pick a number when we enter the market. And when we pick a number to enter the market, we want to find comfort in that number. We want to be right. Using indicators combined with education can participate in your success. Be careful with the indicators you use, or you will just be jumping through financial hoops, creating losses. Backtest everything that you do. There are trending indicators with buy and sell signals and indicators to help you in sideways markets. Be careful as you place too many indicators on your chart. Too many indicators can create confusion. There are a lot of books out there that talk about all these different indicators. Whenever you go to the help section of your data provider, in that help section, it can teach you all about the different indicators. But too many indicators have a tendency to create confusion and frustration. So remember to simplify your trading techniques. The market is constantly on the move. The Forex is no different than the rest of the market. It is constantly either moving up, down, or sideways. And as it's moving up, down, or sideways, it is moving within a swing fashion. Look at this chart. Market started to move up, then it went sideways, created what's called a diamond pennant right here. It started to break out of that pennant, then took off into a trending fashion. Be that as it may, look at how it's constantly swinging as it's moving, either moving sideways or trending. Now, just as there are trends inside of trends, there are swings inside of swings. Look at how all these little swings create one big upswing. Look at all these little swings as the market moves, creates one big upswing, making this a large uptrend. You had an uptrend here, a downtrend here, then an uptrend here, but an overall uptrend. Swings inside of swings. Just like there's trends inside of trends, which is lesson 5. Look at how we're trending up here, then we speed up, we trend up, we slow down, then we start to reverse via crown. Which is one of our lessons. Then we go into a downtrend, then we crown again, then we reverse and go into an uptrend. However, we're still in an overall uptrend, just like there are swings inside of swings, there's trends inside of trends. Look at this uptrend, market breaks the trend line, goes into a downtrend, breaks the downward trend line, starts to move in an upward trend line. Look at how the market bounces off of these trend lines. Overall, we're in an uptrend. Either way, it is constantly reversing. Up, then down, then up, then down. It never ends. Indicators can help when we get overwhelmed or confused as the market moves. Indicators give buy and sell signals. Indicators can help spot reversals. A very popular indicator is called a modified moving average with the settings of 10, 25. What does the setting 10, 25 mean? That means that one of these lines is monitoring 10 candles back. The other is monitoring the price movement of 25 candles back. This is what it looks like. When you place an indicator over the candlesticks, you can see this is a slow moving average, a fast moving average against a slow moving average, giving off buy and sell signals. This is a sell signal. When the fast crosses over the slow, it gives off a sell signal. When the slow crosses over, the fast crosses over the slow coming from the south to the north, it gives a buy signal. There, right here presently, it's showing a sell signal. But it's clear to see that the market has broken the trend line, and what you want to do is you want to combine your education with the indicator, which improves your percentages of success. Here, the market broke the trend line. It came down to the last level of support. So obviously, that knowledge was acquired way before the sell signal hit. Now, indicators give buy and sell signals in an uptrend as well. Look at how here it's crossing over from the south going to the north. See, look at how this gave a buy signal here. Market was going down, gave a buy signal here, went up, giving a sell signal here. Market's constantly on the move. Key indicators to use is a moving average, stochastics, MACD, and we have some Market Traders Institute custom indicators that you can use. Data and charting companies provide different indicators, and you can find out how they are used to give signals via the help section of your book. Whenever you click on your studies in your charting package, you will usually come up with available studies. All these are different indicators. By clicking on them, you can move them over into your selected studies, which then place the indicator on your screen. Keep in touch with Market Traders Institute and forextips.com to find out about the latest indicators that we are offering our traders. Once again, look at this moving average signal that is giving sells, buys, sells, market's constantly moving. Trading the moving average exponential, that's the one we use. It comes in three parts for this indicator. One is the candles, two is the slow moving average exponential, and three is the fast moving average exponential. The settings once again are 1025. The moving average, you can also use a long-term buy signal, which can have a setting anywhere from 60 to 75. You can add to it, but let's stick with the two indicators that we have. Whenever the fast moving average crosses the slow moving average, in other words, the 10 setting crosses the 25 setting, that can give off a buy signal. It can also give off a sell signal. When the fast moving average crosses from the north to the south, it can give off a sell signal to where the trader can get involved in the market. Now this one, you can see that the fast moving average signal stays closer to the candles at all times, to where the slow moving average setting stays a little further away from the candles. As you can see, as they cross, that is what gives the buy and the sell. Moving averages, here is a moving average setting of setting 5. That is a very slow moving average. You can see that the candles are going across that slow moving average in huge swings, and that it stays pretty flat. That can participate in a moving average buy and sell indicator. There's another indicator called the MACD. The MACD also gives off buy and sell indicators. You can read about its formula in the help section of your data. It is a mathematical equation that is telling the trader that the market is either getting bullish or bearish. It is used with a filter line and works within a parameter usually of starting at 0, moving down away from 0 in a negative fashion, or moving positive away from 0. Either way, how this works is when the MACD crosses over the filter, it gives a buy. When it comes down, it gives a sell, then a buy, then a sell, then a buy. Look at how the market on this sell right here turned bearish, then it turned bullish, and then it turned bearish again coming down, then it turned bullish again, offering buy and sell signals. The other one is stochastics. Stochastics also works. You can read about it in your formula or in the help section of your data. It too offers buy and sell signals. It works from a 0 to 100% range. Whenever the market gets below 20%, it offers buy signals. Whenever it crosses the filter line at 50%, it offers a sell signal coming from the north to the south and a buy signal coming from the south to the north. Whenever the market is overbought, it can start to offer a sell signal. It'll start to U-turn and come down from the range. That means it's overbought. It can also become oversold, offering a buy signal. Let's look at this stochastic buy signal. Whenever if we looked at the range starting at 0 and going all the way to 100 with the filter line at 50, that means everything under 20 can potentially offer a buy. Now, how this becomes real effective is you want to take advantage of this buy signal in the direction of an uptrend. Conversely, stochastics is used giving off a sell signal whenever the market is crossing over at 80% or greater. It is offering a sell signal, but only take advantage of those sell signals in the direction of the trend. Whenever the market is coming up to the 50% filter line, you may want to enter the market as a pure momentum trade. Maybe jump in and go for 40 pips with perhaps a 40 or 50 pip stop. It is based on pure momentum. Conversely, it can offer a sell signal. When the market is coming down, crosses the filter line, that means the market is turning very bearish and it is getting ready to start to have a fast move. You're getting in on pure momentum. You will want to jump in, go for a quick 40, 50 pips, understanding how the price swings work, which is lesson 7. The price swings of Fibonacci's can dramatically increase your percentages of success as you trade. As stochastics start to cross over, if you will, and they start to tangle up in these areas, those can become potential buys. Remember, only take advantage of these buy signals in an uptrend or the sell signals in a downtrend. Now, stochastics is recorded on this chart at the bottom of your screen. You can see that we have moving averages up here, MACDs here, and stochastics down here. These are giving sell signals, buy signals, sell signals, buy signals. Look at how the market responds based on these buy and sell signals. You can adjust your settings and backtest everything that you do. If you adjust those settings in your ranges, backtest before you start to create a system that you buy into. Make sure that as you backtested it, that it becomes profitable for you and that you can make money as you continue to trade. Keep it simple. Do not have too many indicators. Too many indicators create confusion. This is very simple. Look at how we have just a pure moving average up here, MACD here, and stochastics down here. Look at how simultaneously what you want to do is when stochastics is bullish, MACD is bullish, and moving average is bullish, you may want to use the combination of the 3 buy signals to confirm that the market is turning bullish. Look at how stochastic turned bullish first, MACD turned bullish second, and your moving average turned bullish third. Be that as it may, after the 1, 2, 3 all became bullish. Look at how bullish the market came. The market became very bullish, rallying over 200 pips. Too many indicators can create confusion. Keep it simple. Our trading experience at Market Traders has led us to use just the MACD, the stochastics. We used to use PCI. Stochastics is a little more productive than the PCI, as well as your moving averages. Trade the indicators in the direction of the trend. This is an important information. Use them when you spot trend line breaks and crowns and reversals. If you're going to take on a sell signal, make sure that the market has broken a trend line. Educate yourself on how to spot a crown. If the market has broken a trend line, it has crowned, and now the indicator is giving a sell, you may want to take advantage of that sell signal in the direction of the trend, provided that it is within your equity management. Do not trade a signal off an indicator if the risk is too great or if the required stop is too far away. Remember, risk versus reward. For every dollar you risk, you should be going after $1.50 in profit. If you're risking $400 in potential loss, you should be going after approximately $600 in reward. If you're risking approximately $800 in risk, you should be going after $1,200 in reward. Keep your risk and reward ratios in check so that as you trade, you can accumulate wealth along the way. Let's all agree, you must have an edge as you trade. You must educate yourself and know where to get in and know where to get out, and you must know the reasons why behind that. Entering the markets using buy and sell indicators and entering on the buy and sell zones can be very profitable. You must manage your risk as you trade. If the risk is too great, you've got to pass on the trade. Now, did this lesson teach you that the markets can only move up, down, or sideways? Did this lesson teach you about the technical side of dealing with an indicator? Did this lesson teach you how to use the indicators with other knowledge? Did this lesson teach you how to find a trade with an indicator and only trade it with equity management? And at the back of your workbook, it shows how to create the trading plan based on using indicators and how to trade that plan as well as financially protect yourself. Lesson 2 really focuses in on where to place your stops as you trade. Remember, as you're buying, you place your stop at the last low. As you're selling, you place your stop at the last high. Because of this reality that only 10% succeed and 90% fail, you must take the time to properly educate yourself about how the market works. Remember, successful traders will do what unsuccessful traders won't do. They will take the time to learn how the market works. They will properly educate themselves. There's only 2 ways to pay for your education. One is luck. If you make money from trading and you don't know what you are doing, then you got lucky. It will only be a matter of time until you get unlucky and lose everything you started with. The second way is mentorship. Working with a mentor and getting an education on how the market works can be like buying a map to a gold mine. You need to learn where to get in, and you need to understand the why behind it, and you need to learn where to get out, and you need to understand the why behind it. Market Traders Incorporated, as well as ForexTips.com Incorporated, we participate as your mentor. We teach people how to trade. We coach people. A great definition of a coach is an individual who takes an experienced player to a higher level of achievement. We teach a lot of people who already know how to trade. We pride ourselves with taking those already traders to higher levels of achievement as they learn to trade. The greatest part about properly educating yourself about trading is when you take a loss in the market, you know how to earn it back. If you trade off a hot tip and you are told where to get in, you will need to be told where to get out. And if you end up losing money based on a hot tip, then you don't have the education on how to earn it back. That's what education can do for you. Once you've been educated, no one can uneducate you unless you choose to forget what you've learned. Let's face the facts. Every trader wants the market to move in their direction from entry. Education on how the market works improves those percentages. These 16 lessons that Market Traders and ForexTips.com has put together can play a big part in helping you become successful as you trade in the market. They are filled with trading exercises that you can practice with before you trade. We have created a piece of software that allows you to practice trade way before you put $1 of your hard-earned money on the line. Every trader needs to have a mantra. You need to properly educate yourself. You need to learn how to find a trade. You need to trade with equity management. You need to never trade without a protective stop. You need to agree not to chase the market and have all the proper patience that successful traders have. If the market doesn't meet your criteria, then you should not trade. Remember, if the chart is not clear and doesn't make visual sense, when in doubt, stay out. The 21-day 3% rule is all about practicing, rehearsing, re-educating yourself. The human mind forgets 80% in 3 days. By practicing and re-educating yourself on how the market works, it places you in a position to start to trade with about 80 to 90% recall versus 3%. We do not want you to open up your margin account with only 3% recall of all the things that you've learned. In closing, I would like to say thank you for investing in yourself and purchasing this lesson. Everyone at Market Traders Institute, as well as ForexTips.com Incorporated, would like to thank you.